Good morning, everyone. I'm Juliette Williams, Bieber Area Manager for the Central Region. I'm here to introduce Ashley, who, with nearly 2 decades of frontline insurance broking experience, now spearheads FullCircl's insurance division. His expertise empowers brokers to have more impactful conversations and connect effectively with their customers and prospects. Ashley's career journey began at A-Plan, where he served personal lines clients before advancing through commercial and large corporate divisions. He has successfully led teams of insurance consultants in both sales and retention roles, with notable stints at Howden and the NFU Mutual. Ashley's specialisation lies in equipping clients to deliver advice-driven sales, accomplished by unlocking the invaluable insights within company intelligence, a critical asset for today's modern insurance brokers. Ashley is joined by Gareth Woods, FullCircl's in-house chartered accountant with nearly a decade of experience in company accounts. And Gareth is here to support Ashley with any specialist questions you may have around financial data. FullCircl delivers company intelligence to 9 out of 10 of the top UK brokers and 40 out of the top 50. FullCircl's Smart Broker is also proud to support many other independent brokers and is one of Bieber's newest facility providers. So, without further ado, Ashley, over to you.
Thanks, Juliette. Well, a lovely introduction, and thank you everyone for your time today. As Juliette said, I've worked at some of the largest brokers in the UK and run sales enablement programs to help them be a trusted advisor and give their client the best level of support. At the core of the methodology we've always applied is data-driven, advice-led sales. And the real key to that, or sort of the first step, is having a good understanding of some of the basics of company accounts. So today we're going to go through how you can analyze those accounts and unlock sales opportunities and get the true value out of them to help you deliver positive outcomes to your clients and give them the best advice possible. So our agenda today, we're going to quickly go over the learning objectives. We'll cover the basics of annual accounts, particularly those 3 main statements and some key financial terms. We'll then take a deeper dive into some financial ratios, discuss how they can be used as sales triggers and opportunities to uncover potential underinsurance within your portfolio. We'll then have a look at some of the hidden value that's buried away in those later pages of financial statements. And then I'll give you a brief overview of what we do here at FullCircl. So to start with our learning objectives, we've got 4 key learning objectives for today. First, we're going to explore some sales enablement strategies. So we're going to unearth techniques to use company intelligence to pinpoint areas of exposure in clients and prospects, allowing you to deliver positive outcomes. We'll also look at underinsurance and how that you can use company accounts to uncover potential underinsurance in them and give your clients an advice-led conversation about where they have exposure. We'll help a little bit with consumer duty by using that data to deliver those positive outcomes, look at where they are potentially exposed and have financial harm and how you can minimize that. And hopefully tying this all together, you'll walk away with an understanding of some of the basics of financial reporting and some of the key statements there that are involved in that. First of all, just starting with some of the basics of annual accounts. For anyone with 2 of the following must submit full annual accounts. So larger companies with turnover of more than 10.2 million, assets worth more than 5.1, and more than 50 employees. So they don't have to have all 3. They only need to trigger 2 of those, and then they must submit full annual accounts. If they don't hit 2 of those, and they've got a turnover between 632,000 and the 10.2, they can still choose to submit full accounts. And many companies that are close to those thresholds will choose to submit annual accounts as they sway to and fro each year over the threshold. But a lot of smaller companies still choose to as well, as it's best practice. But they can choose to submit abbreviated accounts, which would just include the balance sheet and a bit of additional commentary on what's going on there. And those that fall below that threshold of 632,000, they can submit much simpler accounts. However, there is still value you can find by analysing the statements they put in there, particularly any commentary, any financial data that comes through. When submitting annual accounts, companies submit 3 key financial statements. Now, this includes the balance sheet, the income statement, and the cash flow statement. Now, turning to these one by one to cover off their basics. So the balance sheet, sometimes referred to as a statement of financial position, shows the business at a specific point in time. It includes assets. These are resources held by the business. Liabilities, which are obligations to someone outside of the business. And both of these can be current or non-current. So current means that they're falling due within 1 year. Non-current would be more long-term. It also includes equity. Now, equity are the claims of an owner over a business. So that's money that's owed to the shareholders, owed to the people who own the business there. And it also includes the standard accounting equation, which is equity equals assets minus liability, or assets equal liabilities plus equity, and the various ways of that calculation there. And the real key is that will always balance, because the balance sheet should balance. The next main statement is the income statement. Now, that concerns itself about the flow of wealth. It's sometimes called the profit and loss account, and it's produced on the accrual basis of accounting. Now, the accrual basis of accounting means that revenue is recorded when realized, not when cash is received. So if a company sells a product to another company, quite often they'll have a 30, 60, 90-day invoicing period. That revenue is recorded in the accounts the day the sale's made, not when the company pays the invoice. It includes 3 main measures of profit. Accountancy gross profit. Now, it's a good moment to discuss this is different from how we calculate gross profit for business interruption, but that's simply revenue minus cost of sales. Operating profit, which is gross profit taking away any additional operating expenses. Net profit, which then takes away all of that, adds in non-operating income. Now, non-operating income is income that comes not from its business activities. So if you've got a large business, for example, someone like John Lewis, who owns another business, in this case, Waitrose, they get non-operating income from money they receive from their ownership of Waitrose. And then we finally, to get that net profit, we take away interest from the period. So it will also show what's called retained earnings. Now, retained earnings is the income left over after the business has paid dividends to its shareholders. So those retained earnings are basically money that the business is deciding to leave in the business to help with future growth and potential future aspirations. And the final main statement is what's called the cash flow statement, which is concerned with the management of cash and the effect of the movement of cash. Now, it's important at this stage, remember that cash is not equal to profit. So you can have a very profitable company that's not getting the cash in from its customers or spending too much money with its suppliers, and having a lack of cash, which is obviously also referred to as a lack of liquidity, is one of the main reasons for companies to fail. So in a lack of cash, and the cash flow statement is one of those really important statements to look at to judge the financial health of a company and judge how it's going to continue moving forward. The 3 main sources of cash come from a decrease in assets. So that's when they've sold an asset, they're bringing more cash in. An increase in equities. So that's when the owners and the shareholders invested more money into the business. Or increase in liabilities. So liabilities, like, for example, taking a loan from the bank will increase the cash into the business, but obviously it's a debt that they have to repay in the future. It also defines the cash balance at the end of the year, which is made up from the cash flow from operating activities, investment, etc. Also, some key financial terms that are very useful to understand when analysing a company account. We haven't got time to go through all of them in today's session. So we've produced a document that will be shared with everyone that's attended afterwards that will detail, some of the key terms that you need to know. But what I want to do is just draw your attention to a few key ones that people often get confused or people don't understand. The first one's EBIT, or EBITDA, which defines the income or earnings in this case before interest and taxes are deducted. And then you have EBITDA, which also takes away depreciation and amortization. Now, depreciation and amortization is something that people get quite confused about. There's several different ways you can look at depreciation and amortization. The most common is straight line, but we do have stuff like double declining, units of production, single years. Using straight line as an example, essentially, if you have an item that costs £10,000 and has a life expectancy of 5 years, you reduce that value by £2,000 each year. So taking it from the 10,000 in year 1, and by year 5, when it's run out of its life, it has a value of 0. This is normally done for substantial purchases. It's not done for every purchase, but it's a way of recording that in the accounts. Now, depreciation for intangible assets is called amortization. So essentially, it's exactly the same thing, but it's just about stuff you can't hold, like trademarks, copyrights, patents, and stuff like that. They're shown as an expense on the accounts, but they're classed as a non-cash item. So when banks and people are looking at affordability checks, they don't take depreciation into account. The one I always like to mention is debitors versus creditors, because I think a lot of people often get these. So debtor is someone who owes you money, and they're an asset to your business. So that's money that's due to come in that hasn't come into the business yet, cash that hasn't come in yet. And then creditors are people that you owe money to, and that would go on the accounts as a liability. So the debtor owes to the creditor in a way. Your business is in the middle there. The final key term just to discuss before we go into some more interesting stuff is GAAP or GAAP. And these are the generally accepted accounting principles. And GAAP UK is really the principles the UK is prepared for, but you'll also come across IFRS, the International Financial Reporting Standards. Both detail what information should be disclosed in an annual account, what information should be presented, how an asset should be valued, and how profit should be measured. The real key here is, because we adhere to GAAP UK or International Financial Reporting Standards, you can make direct comparison between accounts because they're done and displayed in the same manner, and they should follow the same manner year on year. So you can do historical comparisons or comparisons with other companies in a similar industry or sector. So set the scene a bit. There's some of the basics of financials, just so we understand what we're talking about. Now I want to show you some of the financial ratios and how those ratios can be used as triggers for conversations with clients and prospects. So there's 5 main types of ratios you'll come across. You have profitability ratios, efficiency, liquidity, gearing, and investment. Profitability looks at how much profit you are generating. Efficiency is how well you are generating that profit. Liquidity is also to do with that movement of cash we discussed earlier. Gearing is all about debt and how you pull debt into the business. And investment is all about attracting shareholders and how you compare against other businesses. Look at them one by one. There's a lot of ratios you can look at, and we're never going to go through all of them in one session. But I want to draw your attention to some key ones that you'll come across. The 2 most common for profitability are normally operating profit margin and gross profit margin. And these you can calculate by looking at dividing those earnings by that revenue. And that will tell you how much how well they're performing profit. But another really interesting one, and one that's really key, is return on capital employed. Now, this looks at how the money that's been invested in the business, whether that's a combination of shareholders' investment share capital, whether that's reserves, that retained earnings we spoke about earlier that people keep in the accounts, or long-term loans. It looks at how they're taking that money, investing it in the business, and how that's generating a profit. And this can be a really strong opportunity to open the conversation up with a client or prospect around premium finance. Premium finance often, in my opinion, when I've worked with sales teams, is a last-minute decision. We've done the covers, we've spoke about all your exposure, do you want to put it on finance? But actually, it can be a really positive way to have a conversation with your clients about safeguarding their future, and also about how, as a brokerage, you can grow your revenue from the commission you make, but also providing those positive outcomes for them. The most obvious one that most people look at and come across is cash in bank. So if a business's cash in bank is decreasing, that can be a really good opportunity to discuss premium finance. It's a way of bringing cash into the business to safeguard that liquidity basis. However, if a business has good cash in bank, a lot of people don't see it as an opportunity. They go, we've got the money to pay, why would we want to put it on finance? And that's why you can have a conversation about return on capital employed. So when we look at return on capital employed, as mentioned, that's net profit before interest and tax divided by share capital, reserves, and long-lasting loans. And it shows how well a company can generate profits from its capital. So if we use some examples from the retail industry, now an academic will tell you when you're looking at company accounts that return on capital employed of 20% is good, and that's what everyone should be striving for. The problem is when you make sweeping statements like that, they don't feel very accurate when you look at all industries. When you're looking at retail, they often operate on lower margins, so they often generate less profit in. So the best way to compare how companies are performing is looking at their peers and comparing them to each other. So here we can see a list of companies and their return on capital employed percentage. And we can see that, companies like B&Q, Poundland and Argos are operating relatively well in the middle of the pack there. Sainsbury's, Tesco's and Marks Spencer's a bit weaker. But then we have our two outliers. So we have Wilkinson's or Wilko's, who actually have a negative return on capital employed. So that's for every pound that Wilko's invested into their business to keep operating. So for every loan, every share, and every retained earnings, they were actually making a loss of 18.3 pence. That alone will show you why Wilkinson's went into liquidation, and that's why they're no longer a viable business, because you can't perform if you're making a loss every year. Matalan, on the other hand, have quite a positive return on capital employed for a retail company at 14.43%. So by looking at your own clients when you're having a renewal conversation and calculating the return on capital employed, you can actually have a really positive conversation about something like premium finance. So if we look at Wilkinson's, Matalan, for example, and focus just on them, what this is, say you had hypothetical renewal insurance premium of £1 million for Matalan, big retail chain, lots of stores, but just a hypothetical figure. If Matalan were to take that £1 million and invest it back into the business, what it's saying from their accounts is by the end of the year, they'd have £1,144,300. They could take that £1 million and pay their insurance premium with it. Or they could put it on premium finance and say it was a 3%, again, hypothetical figures, but say the premium finance charge was 3%. It would cost them £1,030,000. So when you look at what they could have achieved by investing that money into the business, rather than taking finance out, we have what's called an opportunity cost. So when you think about money and cash, it's thinking about what is the opportunity you could have looked at for that business. And that's what accountancy looks at, is those opportunity costs. And they've actually lost out on an extra £114,300. So when you're talking to companies when you're going for the renewal conversation, and rather than making premium finance that last minute conversation about, we've agreed your terms, it's all covered, do you want to pay on finance, yes or no? By actually taking a look at those company accounts, you can show that actually it could be beneficial for that business to take out premium finance. And you can get even more advanced with these sort of investment decisions. Now, some things we're not going to discuss in the course today, when you're looking at long-term investment, there's a few key tools you can use, like net present value, internal rate of return, accounting rate of return, and payback period. These look at what the value of future cash is today and what the value of cash today is in the future. So, for example, if you've got a loan that would take out £20,000 in 10 years' time, in comparison to something that would pay out £14,000 today, it's calculating which one's more valuable. And it looks at those opportunity costs, that £14,000 comparison to that £20,000, and what you could do with that money and which is the better financial decision. But when we're talking about premium finance, there's a couple of other things you can take into consideration when looking at return on capital employed. At the moment, the cost of borrowing money for the bank. Often it's more cost effective. It's a cheaper way of borrowing money. But also you can take into account, on top of the return on capital employed, the corporation tax rate. Because that money that they then choose to use as premium finance, it will come off their tax bill. So it reduces the tax bill. So actually they're making more than just the return on capital employed. They're actually generating additional revenue. This is an area I'm quite interested in, but I'm not going to go more into it today. If you do want to learn more, another BEBA facility provider, Premium Credit, they have a fantastic cost benefit analysis calculator that takes all the information we've discussed. It takes your return on capital employed, takes your tax rate, and it calculates actually what the net result would be for the business. So I'd recommend speaking to Premium Credit if you want to learn more about how that can work. The key takeaway from that ratio is return on capital employed can be a way of generating positive income. So now turning to the efficiency ratios. Efficiency ratios look at how well a business is performing. And this can be a great one to compare with businesses of a similar size. The three main you're probably going to come across are average inventories turnover period, stock days. So this looks at how long a company holds goods in the business before it sells it. So this is quite low for retail outlets, quite churn, but for big cost-effective manufacturing outlets, they can hold it for a long period of time. Comparisons between industry aren't valuable on that one. The key is to look at the comparison between companies in the same industry and see how well they're performing. A company that's taking longer to move its goods and has a longer inventory turnover period, they incur additional costs. So you can imagine if you're storing items in a warehouse, there's cost of storage, stuff like that. That's also very applicable when you're looking at perishable goods, stuff like food and drink. If it's taking longer to shift, and actually there is wastage cost as well. The next two that you're going to come across quite often go hand in hand. So average assessment period for trade receivables, average assessment period for trade payables. These are debtor days, credit days. It's how long you're taking to pay your creditors and how long your debtors are taking to pay you. Now, to keep a business very liquid, to keep that cash in the business, ideally, you want your clients to pay you as quick as possible, and you want to delay paying your creditors for as long as possible. However, if you're taking too long to pay your creditors, you lose goodwill, they're less likely to offer you credit terms, your relationship is going to get ruined. And for debtors, you quite often need to give them credit terms as a cost of doing business. The real key here when you're looking at business is looking how that's changed. So if those credit days are extending and a business is taking longer to pay its debts than before, that's a real early warning indicator that something has changed in that business and their financial position may be weakening. But another one that's really valuable, particularly from an insurance perspective, is sales revenue to capital employed. So this looks at, sales revenue per employee. And this looks at how much income to the business is being generated per employee overall. When you're looking at this over a period of time, it can be quite valuable to structure this and see how that's changed. So if we take company X, for example, cake company, back in 2019, they had a revenue of £1 million and they had 100 employees. Then over the next 5 years, their revenue increases, but they don't employ any more employees. So by 2023, they have a revenue of 1.7 million and 100 employees. So this is a nice, simple ratio to calculate revenue divided by number of employees. And we can see how much revenue has been generated by the number of employees. As you can see, that's increased over time. And actually, from a business perspective, a lot of people see that as positive. We're being more efficient, we're generating more income, and we're not increasing our wage roll cost. But from an insurance perspective, you can map that out over the 5 years. And you can see how that company is performing. And as each year, when those companies generate more revenue from their employees, each employee is working harder. Each employee is having to do more. Each employee may be more stressed. And particularly in this case, when you have a steep uptake in the final year, there is a chance that as they're working harder, longer hours and more stress, that something could go wrong and they could have an accident. My very cheesy PowerPoint animation there. And this is a really good opportunity to trigger a conversation about what the business activities are going on with. And when you have a company that has a steep uptake taking this, or a steep uptake, or a gradual over years, it can be a really good opportunity to discuss risk management services by framing the conversation about, it's a good opportunity to review your health and safety policy, to review that risk management, because no one wants to have a claim. The joy of insurance there to cover them, but by having that conversation about preventing that claim from happening and showing to your clients that there is that gradual increase, potentially steep, means their business activity change. It's a good opportunity to spur that opportunity on, is a real valuable tool to sit and have that conversation. But also when you're talking about, it's a good opportunity to talk about loss recovery insurance, such as Lorega, because you can look at that step and say, actually, if you did have a claim, your employees are pretty maxed out because they're working harder. So dealing with the claim itself can be quite difficult. And having the time to deal with that claim can cost you money. As we showed here in 2023, these employees were generating an average of £17,000 per employee. And if you think of one of those employees has to step away to deal with that claim, and okay, it's not going to take the full year, but maybe it takes quite a long period of time to deal with that claim. That time they're spent away from doing their business activities, again, is an opportunity cost for the business. So actually that £17,000 could be better employed, and it's money they're losing. So actually Lorega itself becomes, or like any other loss recurring insurance, becomes it becomes stupid not to pay for it, because it will save you money in the long run. So next, I'll move on to the gearing ratios. Gearing ratios are concerned with debt, basically, how the business is financing itself. And the two main ones you'll come across include interest cover ratio, which looks at how much money the business has to pay the interest on its loans, and gearing ratio, which looks at how a business is financing itself. In this case, it looks at how much of its financing gets taken from exterior loans to business rather than using its own share capital. And you'll often hear the phrase, a company's heavily geared. And a company that's heavily geared is a company that's relying on exterior finance rather than looking at generating its own income. And often you can question, if a business is doing well, then surely it can generate new share capital by selling shares, and surely it retains some of its earnings in its business. If a company is heavily geared and it's relying heavily on external finance, it actually shows a lack of commitment from its own shareholders in some aspects. But particularly if that changes dramatically, and if a company starts borrowing a lot more rather than taking additional shares in, there's a question to be asked. Now, that could be because it's been given an opportunity that's too good to pass up, and they just need to get the money in quickly. But more often than not, that is a sign that the company is struggling financially and has potential risks there. Then we have investment ratios, which look at how well shares in the business are performing. And these are a way of people looking at encouraging shares into those business and looking at, if I'm going to invest in Ashley William Manufacturing Limited or Juliet Williams Manufacturing Limited, which one am I going to choose? I'm going to choose the one that gives me the more money as the investor. And there's a few here you can look at. So, and the key ones that are often most commonly used are the dividend yield ratio. So that shows you how much dividend you get at the end of the year for each of your shares, and the earnings per share ratio, which looks at how much each share has earned each year. The final one then is liquidity ratios, and this looks at how well a company has cash in the business. And there's two main ratios here. There's the current ratio and the asset debt ratio. So the current ratio is the most simple one. It looks at those assets from the balance sheet we discussed earlier, those resources held by the business, and those liabilities that the business holds, that's money owed to people outside the business, to see how well they could cover those. So say, for example, every single one of your creditors, so if your creditors came to you and said, we want you to pay us today, it looks at how well you can cover that by selling assets to get ready. Now, the asset debt ratio takes that a step further. It's viewed that the least liquid of assets is stock. So stock is that asset that takes the longest to sell, and that's often removed from the ratio to show a better indication of how that's performing. Which one of these ratios is more applicable depends on the industry. So, for example, if you are a big manufacturing company that manufactures huge pieces of machinery, they take a long time to sell those machinery. So the asset debt ratio is more applicable. But companies like the retail industry, where stock moves very quickly, then actually the current ratio is more applicable. So speaking of the retail industry, I'm going to use Debenhams now as a bit of an example to show you how you can find this valuable information in company accounts. And we'll take a look at Debenhams. For those of you that are old enough, Debenhams are a retail outlet that similar size to John Lewis back in the day that ended up going into liquidation. And we'll cover why they went into liquidation using these financial information. For the youngsters among you, I think Wilco's a couple of years ago. So where you can get this information, there's a couple of ways. One of the easy ways is to go to Company's House. You click on Company's House, you click Find Company Information, and it will allow you to search for a business to download their annual accounts. So searching for Debenhams here, we can spell it correctly. We can search for the company that comes through, load up the right company, make sure we've got the right one. Under Companies House, you'll then have the filing history of that company, which you can open up, and you can filter that down for the accounts, and then you can pull through the accounts from the year you want to look at. In this case, I'm going to start with 2016, and I'm going to work my way forward through 2016, 2017, and 2018. 2018 was the last year of accounts with Debenhams. You've then got to find the relevant information in the account. At the start of a company account page, there'll be a contents page that tells you where in the company account that information is held. So you can scroll down to the relevant page here. And when you're looking at large companies such as Debenhams, there is a lot of information in these accounts. So finding that information can be a bit tricky and can take a bit of time. But when you come across the right page, and here we're looking for gross profit and sales revenue to show us what their gross profit margin was, you can find that on the income statement. And here we have the revenue and the gross profit. And then we can use that information to calculate. Let's start it again. We don't want to do that. We're starting the gross profit, sales revenue, which gives us a ratio of 12.89%. So that means their gross profit margin is 12.89%. We can then repeat that for the following 2 years, 2017 and 2018. And when we map that out, we can see that there was a decline between 2016 and 2017 and quite a steep decline in 2018. So this shows us that Debenhams was selling their product, their stock, their items for less profit. When we go back to that, the ratio we discussed earlier, the average inventories turnover period, this is how long it's taking them to sell that product. That's calculated by taking the average inventories held, divided by the cost of sales, and timesing by 365 to give us the number of days. Now, average inventories held, you take the inventory from the start of the year and the end of the year. And that information, again, you do the same I've just shown you on the company account, find that information, and that will give you the ratio here of roughly 60 days. And when we map that out across the other 2 years, you can see that Debenhams have gone from just under 60 days, got a bit improvement in 2017, but in 2018, taken dramatically longer to sell those items. So that they're holding stock for longer. It's taking it longer to get it, sell those clothes and other stuff that Debenhams used to sell to companies. When they do that, they're going to be incurring those extra costs because they will have the stock that's on the shelves, but they will have the warehouse in the background that holds the stock that's due to come out. And when they're not selling that, they're incurring holding costs, storage costs, additional costs of those items. Then we can look at how well Debenhams was paying its debts. So the liquidity ratio, current ratio. And as I mentioned earlier, because normally for retail, you can shift the stock quite quickly, this is more important than the asset ratio. So looking at Debenhams' annual accounts in 2016, their current assets were worth just over £500,000, but their current liabilities was 688,000. So that means with Debenhams, if all their creditors turned around and said, we need you to clear your debts today, they could only cover 73% of them. When that drops to 2017, that was 66%, 65% in 2018. So here you have a company that's got a failing ability to pay its own debts, but potentially more importantly, actually in the first year, didn't have enough money to cover its own debts anyway. Speaking of those debts, we can also look at the interest payable, the interest cover ratio. So this is how much money Debenhams has to cover the interest on those longer term loans that it is clearly relying upon to keep the business functioning. As you can see, we're calculating by operating profit divided by the interest payable. That sometimes appears on annual accounts as financing costs. And we can see here that ratio is dropping over time. And in 2018, has dropped significantly. So Debenhams not only is struggling to pay its debts, but any financing it has on its debts, actually struggling to pay that as well. So here you have a company that's gross profit was falling. So it's selling its items for less profit. It's taking longer to sell those items. Therefore, it's incurring additional costs. Its then liquidity position is damaged. It's not got enough money to pay all its debts, and it can't pay interest on loans to cover those debts, which is unfortunately why a major UK brand disappeared from the high street back in 2020, 2019, I think it was. So by looking at a combination of these ratios, you can quickly assess what went wrong at Debenhams as a company. There's other ways we can turn these ratios into sales triggers, and particularly using these ratios to look at underinsurance. So Aviva did a risk insights report recently that said that 50% of UK businesses are underinsured. 40% of building cover policies have at least one premises underinsured, and 40–50% of claims underinsurance is. Now, there's a number of causes of what's driving underinsurance at the moment. Conflicts in Russia and Ukraine and Brexit are both affecting those supply chains. It means it's taking longer to get materials into the UK. It means it's costing more to get those materials into the UK, and that's increasing claims costs. Rising inflation is obviously a big issue, and although that's inflation is starting to look better now, you have to take into account that as items inflate, claims costs will go up, particularly when you're looking at property claims in the UK brick shortage at the moment, and how that's causing issues around getting those bricks in, delaying the rebuilding of property, which also is obviously incurring longer business interruption claims. And taking business interruption as an example, looking at Brewdog. If I take from their profit and loss statement, another name for the balance sheet, and for the income statement, sorry, and we look at their last 4 years worth of annual accounts, and we compare them against each other, and particularly take UK turnover and gross profit, and then map them out across the 4 years. You can see here, Brewdog pretty consistently growing. And I can use that data to map out a trend about how that's been growing through over those years. And we can see that their turnover has been increasing, and the average growth on their accountable gross profit, it's a slight difference from insurance gross profit, but accountable gross profit is an average of 26.5%. Now that can give you an indication of how that business is sums insured, particularly around business interruption, need to be looked at. Too many businesses these days have a 12-month indemnity period. So when we're all now encouraging businesses to look at those longer term indemnity periods, like a 36-month, we should be looking at how that business is growing. Because in the case of Brewdog, if you insured them at the gross profit that they had at the end of 2021, not the gross profit they were projected to achieve in 2024, you've actually left them 22% underinsured. Now, in the case of Brewdog, that's £33.5 million. A lot of money. It's not a claim you want on your E&O statement. The key here is when you go in to see a business and you're having those conversations about their exposure and their cover and where they have potential risk, if their existing broker is not talking to them about longer term indemnity periods, then, and you're going to come out in a better position. But particularly if you can back that up with data and you can sit there and use this information to discuss where their potential exposure is and that potential growth is coming from. And you can do these calculations before turning even up to the meeting. So before you've done that fact find, you can look at this information and you can make a recommendation to them that gives them strength on that. And this is where a business will look at you. You can instantly demonstrate you're a trusted advisor. You're instantly delivering positive outcomes, and you're preventing them from financial harm. Now, we've covered a few today on these financial triggers. We're never going to get time to go through all of them, but there is a fair few more financial triggers that you can find in these accounts. I think the real key that I'd like you to all take away from today is looking at previous years and checking that, looking at comparisons to other companies that do the same activity and showing that company how it's performing. So, for example, if a company's number of employees increased, of course, you're going to be looking at EL. If that's increasing year on year, then potentially when you're looking at the EL at the start of the year, and you can actually give them an estimation where they're going to be at the middle of the year, you might be a better position to protect them properly and look at their potential underinsurance. Stock, obviously there. Trade debtors increases and real valuable opportunity to discuss that trade credit insurance, plant and vehicles for machinery inspection and fleet, expert turnover. Great opportunity to start the conversation about any marine cover, any PL cover, any conversations that need to be had about potential trade credit. And there's so many more triggers you can use that will help you. And today we've only covered off a few of them, but the same principles we applied can be applied to any of these figures to give that advice-led sale. Now, we've talked about the financial statements. I'm about to go on to other hidden information you'll get from the statements, but this might be a good opportunity if anyone's got any questions at all, or I mean, either I'm boring you all and you've all fallen asleep, or if you have got questions, then hopefully I'm doing a good job to explain it. But does anyone have any
So
questions?
I've had a few questions saying, is a copy of the recording and the slides going to be available afterwards? So I've let people know that they will be put on the Bieber website, so you can play again at your leisure and download a copy of the slides. I think like a lot of people, people probably rewatch this just to sink it, to everything to sink in. And we have had a question through. So what about companies expanding too fast, which depletes resources and can mean expanding into bankruptcy?
And it's something that does happen. There is a potential, actually, if you, John Lewis at the moment are a company that I would be watching as they've been expanding, because you can look at their ratios. And the key there is having that conversation with clients. If a company is expanding, how are they financing that expansion? So I would look at those that ratio for the return on capital employed, see how much interest are they generating enough. I would look at that gearing ratio and see how they're being geared. If a company is expanding very quickly and they're relying on those heavily on those external financing arrangements, I'd be questioning why their own shareholders don't believe in the expansion and they're not investing more of their own funds into that. Now, sometimes they don't have the facility. And that's the real key of what you guys do as frontline brokers, is going in and having that conversation with the company, but spurred on with that. I can see you expanding, but I can see you doing that heavily on finance. Can you tell me why? And having that conversation. Where the biggest problem then comes from those expansions does come from that liquidity issue. And as those companies bring in more debts, bring in more liabilities, and bring in more costs to the business, but they don't match it with the assets, keeping a close eye on expanding businesses' liquidity ratios, either the current or the asset one, as that expands, can be a real indication of potential failure. Hopefully that answered whoever's question it was. If you want a more technical answer, I'm going to have to call on Gareth for that, but that should...
I'm going to take it as though that answered it, unless anybody comes back to me. So yeah, you can carry on, Ashley.
Brilliant. So now what I want to do is move on to hidden value from the statements. So these are statements that are, these are information you can find within the statements. I'm going to use Metro Bank as an example, because if you might have seen the news yesterday, they are desperately trying to seek investment at the moment. Now, I've taken their annual accounts for the year, and we've so far focused on those financial statements. But actually, there's another area where you can get an awful lot of value called the strategic report. Within that strategic report, you get a lot of valuable information that you can assess very quickly. So first of all, you have the summary of the year. This summarizes the key financial position and often provides comparisons to the year before. A lot of the stuff we've gone through about doing the calculations ourselves, often you can actually find a summary in the summary for the year. I would always draw caution on using the information they put in the summary, because a business acts as if it's an ongoing concern. So it has to promote itself as if it's continuing to continue indefinitely. So what they will often do is in the summary only show the positives. So sometimes calculating the negatives from the financials is valuable, but it can give you a good overview of what the business is looking at. You'll also get statements from the chair and from the chief executive on bigger businesses. This will tell you other information that's very useful for how the company's performing. For example, in the CEO document, you'll find HR information that will show what steps they're taking to protect their employees and stuff like that. Can be really valuable, obviously, for looking at their employers' liability, or even discussing risk management. It will discuss how they see themselves as performing, and quite often what their plans and goals are moving forward. Next, you'll get the strategic information. So strategic progress will discuss how they've performed previously, and strategic priorities will discuss how they're going to move forward. Now, for me, this is one of the most valuable things that any salesperson in any industry should be reading before going into any client meeting. Understanding what that client is saying its strategic priorities are allows you to align your messaging to what they need. Look, annual accounts are released as a statement form in time, and often you're in the year that's going on. So some of the information is slightly out of date and stuff like that, but the strategic priorities will be relevant to the year they're currently in. So when you're doing outreach to a company, aligning your messaging to what that company is saying its strategic priorities are is going to make it land. It amazes me how many letters I get on LinkedIn I get from people who've not researched who we are and what we do, let alone what our priorities are. Because if I've got a problem and you can solve it, I feel like I'm about to go into Anton Deck then. Like, if I've got a problem and you've got the solution to my problem and you message me at the right time with that solution, that can be really valuable. When you get into insurance, one of the key areas where you can really get into that is the risk report, or the principal risks and uncertainties. So large companies have to disclose what they think is most detrimental risk to their success of this year. And this can be a key opportunity to reach out to them to discuss solutions to those problems. So a couple of key examples of those, if we look at Metro Bank, for example, they have several areas of that strategic report. They have the credit risk, they have the capital risk, and they list out all the sorts of risks they pull. I've pulled some example here where they identify financial crime and sanction risk exposure are two of their key risks at the moment. So providing them a need for management liability to make sure they're adhering to those things is something they've clearly identified. But within their operational risk and an area called cyber risk, they have defined they feel a need for there's growing number of cyber attacks, growing intensity, growing strength. So if you're not discussing cyber insurance when you're trying to insure Metro Bank, you're not aligning to what they see as their biggest threat at the moment. And your messaging is not going to land as well as someone else that's messaging to them. And whether that's even when you're doing outreach to a new prospect, calling out the fact that you know they've identified this as a risk and you have a solution to that risk can be really valuable. Another couple of examples of that, if you look at Next, for example, they define in their principal risks and uncertainties that warehousing and distribution is one of their key risks, and their reliance on suppliers is one of their key risks. They even use the phrase business interruption on their accounts. So if you're not discussing business interruption insurance with Next, then your messaging is not going to land. But the key here is one of those areas of cover that get very glossed over in an insurance renewal quite often. You know, we talk about business interruption insurance, we talk about gross profit insurance, and we talk about maybe revenue and gross profit. And then you go, do you want cover for this, all the extensions? But actually, by spearheading the conversation with Next about key supplier cover, you've shown that that's one of their key areas they've identified as a potential risk. And if one of their suppliers was to have an issue, they're telling you they want that cover before you even step foot in the door. Then looking at BMW actually produce a year-on-year comparison. So they classify their level of risk from high, medium, and low, and they identify if that's changed from the year before. They also then in their accounts identify plant downtime as being an issue, and plant issue, and economic issues. So they're clearly saying that there's a need for business interruption insurance, but potentially a cover for political risks insurance. See what they've increased, but also I would be discussing machinery inspection cover with them, making sure that machinery is not going down. These are three big companies: BMW, Next, and Metro Bank. But most companies will list out their strategic report. They're in there under the strategic report, under principal risks and uncertainties, the biggest challenges they are facing. So that's something key that you can engage with and look at to make sure, even before you book a meeting. For me, this is the most valuable when you're trying to get your foot in the door. By sending targeted messaging around the covers they need, it's invaluable when they're telling you the covers they need before you've spoken to them. So we've gone through quite a lot of information about accounts. I understand a lot of this is quite daunting. So as Juliet said, the recording is available. However, what we do at FullCircl is help you simplify that whole process. Now, at FullCircl, we're all about customer lifecycle intelligence. And our goal is to help you win the right customers, onboard them faster, and keep them for life. We do this for over 200 independent brokers in the UK, 9 out of the top 10 largest, and 40 out of the top 50. The proof how we do this includes, for example, with PIB, we help them increase new business by 80%. We save frontline staff 2.5 hours a week. Aston Lark, we managed to improve their renewal retention rate to 95%, although they're not all Aston Lark anymore, they're now Howden. And with QBE, we help them with their onboarding and reduce their onboarding time by about 80% on it. And a couple of ways we do that includes a whole suite of applications, our web portal and our API. But one of the key ones that link to what we've talked about today includes company data. So you saw how complicated it is to go into those annual reports on Companies House and scroll down for all that information to find the relevant information there. Within our platform, we provide currently the last 4 years of annual accounts digitized for you in an easy to read format, profit and loss statement, the balance sheet, and all those ratios. So you haven't even got to calculate those ratios. We'll do them for you there. We're about to upgrade that to 5 years worth of company accounts to help you do those comparisons. Where we get even more powerful is you don't even have to do the comparisons yourself. Using our new propensity to buy triggers, we will monitor those companies and flag change to you. So, for example, cash in bank decreased by 90%. Our platform will send you an email saying you're interested in business X. Their cash in bank has dropped. Good opportunity to discuss premium finance. Their land and buildings increased by 2,000. Good opportunity to talk about property insurance. Plant and vehicles. Good opportunity to talk about fleet. Another good one of these is export turnover has increased, particularly if it's gone from 0 to having some export turnover, because there is a whole range of advice and products you can discuss with them. And our platform will monitor that in the background and provide that for you and send you that email through when something changes. We are also about to integrate everything we do, and it's in the next 10 days, actually, the launch should happen with Actuaries. So you'll be able to use our prospecting capabilities, you'll be able to enrich all your Actuaries files with the data we have. And you'll be able to, when you go into Actuaries, it will pop up and tell you which of those key changes have happened in that company so you can have that better conversation. Whether that's an exec preparing for a meeting or a broker, a handler that's picking up a call that comes in to make a simple change to something on a policy, and it flags up to him, by the way, we should speak to this client, speak to them about marine cover because they've just started exporting. And the good news is, as a BIBA member, you benefit from 25% discount off our list price. We do multiple seat bundles. We also have the access to FullCircl Academy, which includes a lot of training and enablement, not just about how to use our service, but how to actually understand company accounts, how to use LinkedIn better, how to do various other things. We actually have a new announcement today that for BIBA members, you can get a 2-day free trial to our service to have a look at how this works. Just need to email us at well, you can email me directly or just go on FullCircl and ask for that 2-day free trial for BIBA members. And finally, that's us done. So hopefully we have, just to refresh our learning objectives. So exploring sales enablement strategies, where we've looked at company accounts and we've shown how you can use them as a trigger to look at changes year on year to reach out to that company, particularly using that strategic report, those principal risks and uncertainties to identify where a company is exposed and how you can look at that. Talked about how you can conquer underinsurance challenges by looking at year-on-year growth and providing targeted advice for the future as a trusted advisor that gives the right advice to that company. We've also discussed how you can help, how looking at accounts helps with consumer duty, particularly around where they're changing and that potential for change and exposure, so you can deliver positive outcomes that protect you from financial harm. And hopefully you will walk away with at least a little bit of a better understanding of financial reporting accounts. Otherwise, I have done a very bad job today. And hopefully that covers everything for you. I'm happy to take any questions, but if anyone, just a couple of things from me before we do that. Today we've discussed a lot of financial accounts. If you're interested in learning more about how you can automate a lot of these processes using tech, data, and AI, actually at 2 o'clock this afternoon, a bit of self-promotion, myself, I'm on Insurance TV discussing those things. So if you want to learn more about that sort of stuff, please do tune in. And yeah, just to refresh that as a BIBA member, you can have a 2-day free trial to FullCircl, where we will show you those engagement signals and show you how those digitized accounts to help you out. Just let us know. And then that's, unless anyone's got any questions, that's me done.
Actually, that's been fantastic. I was actually really engaged the whole time. And then people were putting things in the chat. I was like, oh, I need to read that to make sure I ask if anything comes up. But no, that was an absolutely fantastic presentation. Thank you so much for that. If nobody's got any questions, like you say, they might be a little bit like me thinking, wow, it's a lot of information. I need to perhaps think about that, possibly watch it again and go through the slides. But you've just had somebody saying best webinar of the year, nice and clear, lots to look at and review. So
Well, that's very kind. Whoever that was, I'll pay you the £20 I owe you later.
I'm not even going to tell you, so you don't know. So if there are any questions, guys, if you don't have a chance to put them in the chat box now and you think about them afterwards, either email Ashley directly, or if you want to email me, what I tend to do is then go to the presenters, get the answer for you and come back. So it's entirely up to you which way you do it. You will get a feedback questionnaire through from Ruth. If you can fill that out, please, for me, because then it gives us the chance to give the presenters feedback and, feedback for ourselves as well. So if you can respond to that, and then you'll get your CPD certificate as well. So I'm just going to say thank you very much. One quick question that's come in. I'm going to ask you this one. Is the information restricted to limited companies only?
So there's less information available about sole traders. So as you get into sole traders, there is just generally less information available. In the FullCircl platform, we focus on limited companies, but we do have we are working with some companies following on from the open banking legislation to be able to pull through some information on those sole traders to do that monitoring for you. So the answer, you're going to struggle to find information on sole traders, but if you're working with a sole trader and you can get a set of their annual accounts, they're going to have to do tax returns. You can still do the same comparisons we've gone through today. The information is just not publicly available on those sole traders at the moment. But at FullCircl, we are working to make that information available. We've recently just bought a company called W2, who works a lot more with sole traders. And that's going to be part of our expansion to providing you more information to help out there with those smaller covers.
Fabulous. So thank you very much once again, Ashley, and thank you, Gareth, for sitting there in the background ready to jump in on anything majorly technical in the accounts world. So everybody have a great rest of your week, and I will speak to you soon. Take care.